Hey guys, Mike Bonfanti here with Bonfanti Investment Services, and today I want to talk to you about the question, should you invest in an S&P 500 index? I get this question a lot, and I think it's because it's become a trendy topic in the newspapers and magazines, online, and the financial networks on TV. They all make it sound so easy, inexpensive, and generally a no-brainer. Today, let's go through those media talking points and then discuss one big positive and one big negative for index investing. So what is an index anyway? There's many different types of index, from stocks to bonds, international stocks, real estate, but the most popular one I seem to get questions about is the S&P 500. Simply put, it's the largest 500 US stocks weighted by market value in one investment. The argument goes, indexes are less expensive, so you make more money. And active fund managers don't beat their indexes anyway, so performance is better too. They are less expensive than actively managed funds, yes. So the idea is if you're paying less for your investments, they'll grow faster and make a better return. It seems like a solid argument, but if I offered you two investments that had the exact same level of risk, one that made 5% per year and you didn't have to pay anything, or one that made a net of 5.5% per year after expenses, but you had to pay 1% per year to get that, which one would you want? No one's going to say they want the less expensive one. Next, the financial media loves to say only 20% of actively managed funds outperform the S&P 500 index, which may be true, but just using a simple search of actively managed funds on Morningstar that beat the S&P 500 over the past 10 years, have no commissions, and you can still access them, leads you to almost 1,900 funds. Look, I'll admit, this is overly simplistic, but it's also disingenuous to suggest that 1 in 5 funds beating the index makes them impossible to find. The biggest positive point I can make for index funds seems to get completely overlooked by the media, and that's the tax efficiency of the indexes. Now, this doesn't really help you in your 401k or IRAs because they all get tax deferral anyway, but in taxable accounts they actually work really well. In an actively managed fund, anytime a fund sells something that has gains, those gains get passed along to you as the investor in the form of capital gains. In an index, there's very little buying and selling, so you're better able to control your taxable events because you're deciding when to buy and when to sell your shares. My final point in the active versus index debate is that none of this is a no-brainer decision because of how people actually react when markets rise and fall. Everyone's aggressive when the market's going up. They only act like Chicken Little when it's going down. People that are writing these articles have no idea how you're going to react. While the market's proven to be a great investment over the long term, it runs into plenty of bad times. The S&P 500 index fell 56% during the last recession, and 49% in the recession prior to that. You'll need to ask yourself honestly if you can handle that much of a decline without making changes. If you do some research into those two recessions, you'll find that plenty of the active managers significantly outperformed during the fall and in the immediate recovery. The reason for this is sometimes when good things happen, a particular investment becomes overvalued and is more risky, and when bad things happen, investments become undervalued and they tend to be a better buying opportunity. The theory goes active managers may be able to take advantage of this while indexes can't. In conclusion, anyone who says one is definitively better than the other is oversimplifying what a sound investment plan should look like. In the end, there's probably a good place to use both strategies. If you have a question or want to share your opinion on the active versus index debate, please find me at bonfantiinvestments.com.